All right, welcome to This Explainer. Today, we're putting on our financial detective hats and acting as professional equity analysts to conduct a really rigorous stock valuation. Our subject? Mirum Pharmaceuticals, trading under the ticker MIRM. Now, our main goal here is to uncover the true intrinsic value of this company using professional Wall Street models as our investigative tools. We're going to strip away all the market noise, ignore the hype, and look purely at the data from their latest filings to see if the price tags actually make sense. Let's get right to it. First up, just take a look at this number. $6.411 billion. That is the sheer scale and current market capitalization of the company we're investigating today. With a trading price of around $105.81 per share, the market is practically shouting at us that this mid-cap biotech firm is incredibly valuable. I mean, it sets a seriously high bar for the financial performance we expect to see under the hood, right? But hold on. Immediately, we hit a brick wall. Contrast that massive $6 billion valuation with this little nugget. MIRM's trailing 12-month net income is negative $23.36 million. And honestly, this is the core mystery of our investigation today. How in the world can a company that is actively losing money on the bottom line be worth over $6 billion to investors? So, to figure this out, we need a structured forensic path. Here's our game plan. We'll start with the MIRM mystery, then move through absolute valuation, relative valuation, and asset-based valuation before finally synthesizing all our findings into a final intrinsic value. All right, part one, the MIRM mystery. Let's dive right into this by analyzing the totally contradictory top-line and bottom-line data points we extracted from the company's financials. Notice the paradox we've got visualized here. Look at the top line. Trailing 12-month revenue is a super healthy $521.31 million, boasting a staggering 3-year compound annual growth rate of 89.02%. That's huge. Even better, they actually have positive free cash flow of $54.87 million, growing at nearly 35% annually. Yet somehow, the net income is stuck in the red, with a net profit margin of negative 14.73%. They're selling a ton and they're generating cash, but accounting-wise, they just aren't turning a net profit. This right here is exactly why your standard surface-level valuation is so incredibly tricky for this stock. Moving right along to part two, absolute valuation. Now, absolute models try to value a company based purely on the intrinsic cash it generates, totally isolated from market moods or what competitors are doing. Our first tool is the dividend discount model, or DDM. But right out of the gate, this lens fails us. Why? Because the data explicitly shows MIRM has a 0% dividend CAGR. They pay 0 dividends. Well, that's not a dead end, though. It's actually a major clue. It tells us this is a hypergrowth stage company that is reinvesting every single penny back into its operations. Because of that, we have to pivot to the discounted cash flow, or DCF model, which relies on projected free cash flows instead of dividend payouts. For our DCF, the step-by-step calculation requires some serious logic and discipline. It's a 3-step process. Step 1, we project the future free cash flows. Step 2, we discount those future cash flows back to their present value today using an appropriate discount rate, which is typically the weighted average cost of capital, or WACC. And step 3, we calculate a terminal value for what the company is theoretically worth into perpetuity, and we discount that back too. No, because the source documents don't just hand us a crystal ball for management's future guidance. We, as analysts, have to make some sensible, clearly stated assumptions. We start with our known base free cash flow of $54.87 million. For near-term growth, let's be generous and assume they maintain their historical 3-year average of about 35%. For our discount rate, given the inherent volatility of a biotech company with negative net income, a WACC of 10 to 12% is a very standard, prudent assumption. And finally, for terminal growth, we'll just use a standard economic baseline of 2 to 3%. And, this brilliantly illustrates the tension in the stock price. When you actually run those specific inputs through a standard DCF model, the present value of those cash flows does not sum up to a $6.4 billion market cap. The implied intrinsic value sits much, much lower than the current $105.81 trading price. So what does this actually mean for us? It means the market isn't pricing MIRM based on its past 35% cash flow growth. Investors are paying a massive premium because they fully expect free cash flow to radically accelerate and just explode upward in the coming years. To verify this, let's try one more absolute model, the residual income or RI model. This one is incredibly useful when DCF results feel a bit fragile or overly sensitive to growth assumptions. It basically starts with the current book value of equity and then adds the present value of future residual income, which, simply put, is just net income minus a charge for the cost of equity. Here's the kicker, though. The crucial point is how this model handles Mirum's unique profile. Because Mirum's net income is deeply negative at negative $23.36 million, the very first step of subtracting an equity charge yields an even larger negative residual income. In short, the RI model doesn't just flag the stock as overvalued, it actively punishes it. It really highlights the fragility of absolute valuation models when you apply them to unprofitable, hyper-growth biotechs like this one. All right, let's switch gears to part 3, relative valuation. If absolute cash doesn't justify the price, let's see how the market prices Mirum compared to its standard industry peers. The source data gives us some absolutely fascinating multiples to look at. Mirum has a price-to-sales ratio of 12.30 and an enterprise value-to-sales ratio of 12.16. Assuming healthy biotech peers trade around 4 to 6 times sales, Mirum is sitting at a really steep premium. But you guys, look at that EV to EBITDA multiple. It's over 3,000. Standard peers trade at 15 to 20 times. A multiple over 3,000 practically breaks the calculator. It indicates that their current EBITDA is barely hovering above 0, making the ratio just skyrocket. On a relative basis, Mirum is trading at an absolute unmitigated premium. We also have to look at the balance sheet multiples. Mirum has a price-to-book ratio of 17.45. Let's break down what that actually means for an everyday investor. It literally means that if you buy the stock today, you are paying $17.45 for every single $1 of actual net assets currently sitting on the company's balance sheet. You are not paying for current assets. You're paying purely for the massive future potential of their pharmaceutical pipeline. Moving to part 4, asset-based valuation. Let's completely strip away the growth hype for a second and look purely at what the company physically owns minus what it owes. To compute the net asset value, or NAV, we need to adjust the balance sheet to fair market values. Now, the data didn't hand us the raw balance sheet directly, but as analysts, we can easily reverse engineer it. We take the market cap of $6.411 billion and divide it by that price-to-book ratio of 17.45. That gives us an implied book value, or equity, of roughly $367.4 million. Furthermore, dividing the market cap by the $105.81 stock price gives us an estimated 60.59 million shares outstanding. So, by taking that $367.4 million in equity and dividing it by the 60.59 million shares, we arrive at our NAV. The estimated net asset value is approximately $6.06 per share. Just let that sink in for a moment. Sharply contrast that $6 hard asset baseline with $105.81 trading price. It shows you precisely how little of the current stock price is supported by physical, tangible assets today. Finally, part 5, synthesizing intrinsic value. All right, let's bring all our clues together to synthesize these totally contradictory models into a final valuation verdict. We've run the gamut of professional techniques, and here's our synthesis. The asset-based NAV gives us roughly $6.06 per share, but honestly, its reliability is pretty low because biotechs derive value from patents and future drugs, not just current cash in the bank. Relative valuation shows the stock is highly overvalued compared to standard peers, trading at extreme multiples. And our absolute DCF model tells us the stock is only undervalued or fairly priced if you assume their free cash flow growth will exponentially explode way past historical averages. So traditional models scream overvalued because that $105 price tag is entirely dependent on sustaining 89% revenue growth and finally converting it to massive bottom-line profit. So we've really uncovered the true intrinsic mechanics of Mirum Pharmaceuticals today. The data shows a company where the top line is surging, but the valuation is priced for absolute literal perfection. I'm going to leave you with this final thought to consider. As an investor, is paying a massive premium today worth the hypergrowth of tomorrow? Or is Mirum priced for a perfection it simply can't sustain? Thank you so much for joining me on this explainer. Keep analyzing, keep questioning those numbers, and I'll see you next time.